Okay, hello everybody. Welcome to Korean Atlanta Mentorship, aka the Velocity Banking Cult. And I, as your charismatic cult leader, will teach you one of the most important things about velocity banking, and that's that we don't save money. So you are forbidden if you enter this cult to save money, right? And I don't know if this is me right here as your charismatic cult leader. But before we get started, let's do this, okay? Let's go ask ChatGPT. Can you describe velocity banking in the tone of a charismatic cult leader, right? And let me fix this. And so let's go ahead and see what ChatGPT says. Oh, man, I love it. I gotta play the audio to this. I'm not gonna read the whole thing. I'll just let ChatGPT read it for me. All right, let's go ahead and read this. Okay, let's click here.
Velocity banking is the secret the banks don't want you to know, the ultimate financial weapon designed to unlock your freedom. Imagine this: breaking free from the chains of your 30-year mortgage, taking back control of your finances, and living life on your terms. Velocity banking is the path to your liberation, my friends. This isn't just another banking strategy. Oh no, it's a movement. You see, the world has trained you to be a cog in their system, to play by their rules. But today, we cast off those shackles. With velocity banking, you're flipping the script, using the bank's money against them. You'll attack your debt with precision, leveraging lines of credit like a samurai wielding a blade, making payments in chunks, slashing years off your mortgage. This isn't just a technique, it's a revolution in personal finance. The banks want you locked in, paying interest for decades, but not you. You're part of a select few who know better. You're playing chess while they're playing checkers, moving ahead while they think you're just another pawn. Join the revolution, break free, and take back what's yours. Velocity banking is more than a tool, it's the path to financial enlightenment. Who's with me?
Oh my goodness, I want to join that cult. Oh wait, I'm the cult leader, so I am part of it. Okay, that was pretty good. I gotta copy that speech and then just say it word for word and practice my delivery. Right? Oh my goodness, what did I like of it? This isn't just another banking strategy. Oh no, it's a movement. You see, the world has trained you to be a cog in their system, to play by their rules. But today we cast off those shackles. Oh wow, that is really great. Okay, so now let's get to the velocity banking of what's forbidden. So basically, it's the opposite of Dave Ramsey's step one, which is save $1,000, right? And actually, it's just saving money in general. Like when we're paying off debt, we can just skip to step two, which is pay off debt, right? And it says accept the house, but I'd still pay off the house too. We just need to do it in the right order. And then if we're gonna have save money, it's after all our debt is paid off, and we don't have to, save 3 to 6 months, right? And then once we paid off all our debts, pretty much at that time, we just easily invest. Okay, so let's go ahead and go to our Excel spreadsheets that we love going to. And again, this is kind of like my prime example of why we shouldn't save money. And in fact, actually, let me do this. Let me go back to Dave's website, because one of the things that he mentions is that if you do the 7 baby steps, you it'll show you how to save for emergency, pay for all your debt for good, and build wealth. It's not a fairy tale, and this is the thing I really want to emphasize, that he says it works every single time. There's no exceptions to this, according to Dave, right? And so let's go back here, right? And so we have our velocity banking spreadsheet, aka a budget. People say, "Can I get a velocity banking spreadsheet?" I was like, "Dude, it's just a budget." Right? That's literally what it is, because there's really two steps to this. Number two, one is a budget, and then number two is a line of credit as your main operating account. So we have our budget here, $9,321.45 in income, and then $9,321.44 in expenses, and we have literally 1 penny left over. Now, ask yourself this: if you're in this situation, how long do you think it would take to save $1,000? Probably not going to be a one day, right? And so this is why when you look at this and you look at Dave Ramsey's statement about how it works for everybody, it's actually kind of absurd, right? So what we're going to do is we're going to have the same income, right? But instead of saving $1,000, we're actually going to go in the opposite direction. So instead of going saving $1,000 as emergency fund, we save zero. Okay, and we're going to go ahead and copy these expenses. But the most important thing of velocity banking is that we're going to have something called cash flow. Okay, and I'm going to show you how I do this. Okay, so if I take a look at my checking account, money comes in and it goes out, and after every single month, my ending balance is pretty much zero or near zero, right? And that's what we're going to do here. After every single month, the balance of our savings or checking is going to be zero or near zero. We're going to assume for the purposes of this video, it's zero. Okay, but the second step is that we need a line of credit as our main operating account. So again, let me take a look here. So these are the two important fundamentals: no savings, and we have a line of credit for us to use as our main operating account. So I could use this HELOC right here, 280 grand, or if I can't get a huge HELOC like 280, I could just do 15 grand, right? And I know what some of you think, because I see these comments all the time like, hey, how do you get these lines of credit? And I'm going to tell you the secret, and nobody really believes me, is that you get it when you don't need it, because banks don't lend money to people who need it, okay? So I'll go over that in more detail in another video, but we need a line of credit as a main operating account. And what's a line of credit? All it is a financial tool where you can borrow money, pay it back, and then use it over and over again, right? And so let's just assume that we have a home equity line of credit available for us to use at, we'll just use this number, $280,000, right? So we'll say it has a $280,000 limit. And if we get it from a credit union, you could probably get an 8.5. Oh, what happened here? Let me go ahead and format this, right? Format number. Okay. So point, oh, actually, let me just reformat this. We'll use three numbers. We'll do this. Okay. 0.85 interest rate, right? So we're going to do a 0.085, 8.5% interest rate, which is actually the current interest rate of my HELOC. And the cool thing about this is that it's such a flexible tool. You could borrow money whenever you want. You could pay it back, and your savings account is whatever is available as your limit in your HELOC, right? Minus your balance, okay? And so we don't need a savings account anymore because our HELOC is our new savings account, right? And so once we've moved some debt into the line of credit, and again, how long is it going to take for us to save $1,000? I've actually calculated this out, believe it or not. I did this whole table. Where is it? Oh, called, yeah, I did this whole table about like what the payment amount is for 10 credit cards at $167,000, and then you have one penny left over in savings, and then obviously as you pay the minimum debt or the minimum payment for those credit cards, the amount that you actually pay goes up and up, or actually the principal goes up and up. So here we have a penny left over, and then if you look at the total cumulative left over, to get to $1,000, it actually takes us 7 months. But here's the thing: it takes us 7 months to save $1,000, but look at the cost of that 7,000 or 7 months, which is 24 grand in interest. 24 grand in interest. So I don't know if it's a smart move to waste 7 months of your life to save $1,000 and then pay 24 grand of interest. But that's essentially what we're doing here if we try to save $1,000, right? And you go to bankrate.com and then just kind of run these numbers here to see that I'm not lying. But it took me a long time to kind of construct this in Excel format to figure out how long is it going to take to save $1,000. It's actually 7 months. It's like, whoa, I paid 24 grand just to save those 7 months. Okay, so let's go ahead and do this and move some of this debt. And this is $167,000 of credit card debt. And let's go right here, 167000. And then let's go ahead and do the calculations. I2 plus 1. And then now it's previous month's balance plus previous month's interest to get the next month's balance minus, guess what? I didn't even calculate our cash flow, okay? So let me actually ask you this. If I move this $167,000 of credit card debt, these 10 credit cards, what happens to these payments here? Okay, zero, 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 zero. Oh my goodness! Even though we haven't saved money, we went from a penny to $5,345 of cash flow. And whenever I show this to people, it takes them a while to see this. Like, wait a minute, how does that work? Right? Because it seems like magic. How do you turn a penny into $5,345? By making your line of credit as your main operating account and moving what we call inefficient debts, right? Usually high interest debts are inefficient debts, but there's other factors like the loan amount, right? And as well as the time period of the debt, right? So now that we moved some of that debt, now what we do is we put that entire paycheck into the line of credit and then we take our expenses out of that line of credit, right? So that's basic the velocity banking strategy. And then this cash flow is going to be used to drill down our debt. Now remember, what we're doing, if we're doing the Dave Ramsey way, is we were saving money, right? We're trying to save money and then just pay 21 or 27, how much was it? $24,000 of interest just by making these minimum payments. And in month one or even day one, we saved $0, but we generated $5,000 of cash flow, right? So now let's go ahead and do this. Let's calculate the next month's balance, which is the previous month's balance plus the previous month's interest minus our cash flow, 5345.84. All right, and now let's go ahead and calculate the interest, okay? So the interest is based on the average daily balance, right? And not, I don't want the sum function, I want the average function. So give me 1 second to get that. So average multiplied by the interest rate is 0.085, assuming we got it from the credit union, and then we divide by 12, right? Because that interest is calculated monthly, and so we got to divide by 12 because they always quote it annually, but they really calculate it monthly. All right, and then now what we do is go ahead and copy and paste these formulas, and you can see that, well, blam, we paid it off in about 36 months. 36 months. Now, I know what some of you are thinking. Well, what if we have emergencies? Well, guess what? Our line of credit is essentially our new savings account, and that's why we don't save money, because every dollar that we get, we want to make sure that it's actively applied to paying off debt, right? So we're going to say our savings is this number minus our balance, okay? So let's just do this, 280,000 minus H2 is our new savings. And if we go ahead and do this, Control C, and copy this formula, we see that our savings is growing. Now let's say, okay, let's say that we had an emergency. Well, no problem, because again, our savings is so huge, and maybe we have a $3,000, I don't know, emergency. Well, let's just add $3,000 at the very beginning, 170,000, and then we'll blam. So you can see that the payoff time is still the same, 36 months, right? That's the power of using your entire paycheck into that line of credit and expenses out with our cash flow being so huge, right? Now, here's the thing. If we had a $3,000 emergency, so let's say we had a $3,000 emergency, and let's say we didn't use the strategy because we didn't know it, and we didn't know how to use our line of credit as our main operating account. I'm going to show you what happens, okay, when we don't use our line of credit as our main operating account. Instead, we use our checking account as our main operating account. So what happens is that a lot of people are like, well, if I had a $280,000 line of credit available, then this strategy would be so easy. And I'm going to tell you that's actually not. In fact, I've gone over in other videos about Reddit posts about how people are struggling with HELOCs, and I'll tell you why. Okay, so let's say we had a $3,000 emergency and then we had a $280,000 line available to us. Well, if we're not using our line of credit as our main operating account, okay, guess what happens? So we'll just say that for this line of credit, $50 is like the minimum payment, okay? Well, what will happen is in this situation, they're just going to have another, okay, $50 expense, right? Just add 50 to the expenses, and then guess what? Now we're at negative savings because they did not make their line of credit as their main operating account. And do you see what happens when you try to use your checking or savings account as your main operating account? You just don't increase your cash flow, right? Whereas here, when we did not have any savings, and again, I practice what I preach right here, which is money comes in, money goes out, and it goes into the line of credit. And after every single month, and I know some of you are out there because I've seen those comments where it's like, I have all these years of conditioning and I feel like I need to save money, right? I need to save 3 to 6 months of expenses or something like that. Because what if I have an emergency? Well, we just saw that our line of credit is our emergency account. Yet if we don't make it our main operating account, it's just going to be another payment, and then we're going to be in negative savings territory. And oh my goodness, what happened here? Whereas here, when we had even had a $3,000 emergency, it was like the same time time payoff. It's like, I always hear this phrase, "Oh my goodness, velocity banking is like magic," but it's not. It's not, because you can do what I do using math and Excel, right? Again, it's not that hard. It's just A minus B. Okay. So, yeah. So, again, just another review of velocity banking. One of the most fundamental teachings is about how you are forbidden from saving money. Now, praise me as your charismatic cult leader. No, I'm just kidding. I'm more like well, I'm not like a Homer Simpson, but maybe I'm like an accidental cult leader, like Homer Simpson. Actually, let me go back here. Yes, this is probably me in my couch and just hanging out, or this one right here, or yeah. But my point is this, right? So if you were learning this from me directly, and again, I don't give advice to anybody. There's a legal liability element to it. I would just say this. At least I'll say this to myself. If I were to join this quote organization, fraternal organization, I would be forbidden from saving $1,000 and and I would have to be forced to do the opposite of step one, right? All right. Well, just another review for today. So hopefully you're not as sleepy as I am, because it's actually 1 a.m., but it's all good. All right. Well, that's it for today. Hopefully, you'll be accustomed to not saving $1,000 in order to pay off your debt and use your entire paycheck and put in that line of credit and your expenses out. All right. Well, have a great day, everybody, and we will speak next time.